Hello, I'm Tom Martin, and welcome to another episode of San Francisco Conservative, the new podcast series where I, Tom Martin, get to ask thought-provoking questions, inquisitive questions. I'm a lifelong journalist. I produced for Diane Sawyer at Good Morning America at ABC News, and for Charles Kuralt at CBS News, and many, many other places over the years, CNN, and so on. And I love the conversations that I have with my dear friend on the other coast. I'm in Connecticut, despite the Golden Gate Bridge that you see behind me there. But my friend David Parker is the author of Income and Wealth and a San Francisco conservative, and he joins us from San Francisco. Hey, David, how are you today?
I'm fine. Tom, how are you today?
I'm doing well. I'm doing well. On the date we're recording this, we may hit 100 degrees here in Connecticut. We think of, New England has a little cool breeze off the water and the beautiful fall leaves. We don't think about, it's not like Phoenix, Arizona or something, but it feels a little bit like it today, but that's okay. My dog is under the fan as we speak, so we're always okay. But it's funny, David, one of the reasons I love our conversations is because you are a true Renaissance man. Including, I'm sure, an appreciation for literally the Renaissance as one of those great historical eras that we talk about many times. But you are a lifelong educator, having taught children in San Francisco's public schools for 40 plus years. You're a jazz musician. You're an investor. I know you're an art collector. You appreciate art, appreciate world travel and great cuisine and all that. One facet that I don't think we've talked about very much in this podcast series is one of the many hats that you wear is a real estate investor. How did you get started in that? And is that something that anyone can do? Or, what? I am not a real estate investor, so I'm just so curious about it.
Yeah, there's two answers to that. One, anyone can do it at a certain level. My Income and Wealth has a short chapter, how a minimum wage employee can become financially independent in 10 years at the wage that they're working at. Someone who's earning much more can become financially independent at that much more salary. And without any real skill, but a little bit not so easy, but you save half your salary, half your gross salary, and every year purchase an income producing asset with leverage. Buy the house next door. If 10 people are offering a certain price, that's what it's worth. Don't worry about what it costs. Next year, buy the house after that. And if the house is too expensive, do it with your spouse or do it with a family friend or somebody. Buy the corner grocery. Buy some trucks, start competing with Amazon. Income producing assets, one a year for 10 years, and then you're done. The loans pay down, the rents, income rises, you have depreciation and interest, tax write-offs. Pretty soon you're not paying taxes anymore. And all of a sudden you look at your books and there's income is equal to what you were earning before. You just have to do it. You don't commute. That might be an hour each way. Live around the corner from where you work and put those 2 extra hours of commuting into work at time and a half. San Francisco minimum wage is $15. Time and a half, that's $22.50. You're earning 2 hours a day, 365 days a week. You're earning $22.50. All of a sudden, that's gone up, and you're saving your money. You're living over your means, most likely. Share an apartment. You don't have to have your own apartment. Share a car. Share the internet. A bag of oats costs $5. You can make 50 loaves of bread. Instead of $5 a loaf, you have 50 loaves for the same price. There's no end to how you can make this work.
Yeah,
that's a solution.
interesting.
I started as a teacher, and somebody pointed at me. I started so young as a teacher that one of my coworkers was one of my former teachers. He says, "Dave, the first thing you do is you buy a house, and don't talk to me until you bought a house." Oh, that got my attention. And so I was talking to real estate people who were selling homes, and I realized they didn't know that very much. And I had some intuition for this, which I was surprised to find out. And one landlord told me, "I'm not going to rent to you." He says, "The way you talk, you have an investor's mind. You have an entrepreneurial mind. I'm not going to rent you. You go buy a house." And those two things really prompted me, and I realized I did have some intuition for real estate, for financing real estate, for acquiring real estate. And I had just became enormously successful.
Yeah.
In my spare time. My spare
Yeah,
time.
yeah.
It's in my blood somehow.
Amazing. No, I admire that. A number of years ago, I got to meet and be friends with an author by the name of Robert Kiyosaki. He wrote a book called Rich Dad, Poor Dad. He's a Japanese Hawaiian American, grew up in Hawaii. And he said his father, his natural born father, was a teacher also. And he worked in, the Hawaiian public schools and so on. And he said his father's advice was, find a good corporation, get in the door and stay there for the rest of your life and you'll be fine. Well, over the past couple of days, we've learned that it certainly didn't work that way in journalism, I'll tell you that. But I don't know if it works that way anywhere these days. But he said, well, my best friend who lived next door, his father was kind of a colorful guy, an entrepreneur, always checking out, this and that, and, eclectic interests and so on, which I love. And I like that quality about you, I must say. And so he really talked about real estate investing, and Robert Kiyosaki went along to point out again that idea of leverage, that you write about in Income and Wealth, that if you're buying $100,000 property, you don't need $100,000. You go to the bank and so on. Right. So that, I'd like to hear your thoughts on leverage. I'd also like to hear your thoughts. Again, every once in a while, I'll run into a friend or friend of a friend who said, yeah, I bought one house and then 10 houses and 50 houses, but suddenly the bottom fell out and it turned out they obviously didn't handle it well. So how do you avoid one of those, scenarios? I'm just curious about the whole leverage thing.
Well, if you're all failure in any business is because you couldn't hold on during a downturn. Restaurants close all the time. All kinds of businesses fail. They can't hold on during the downturn. And if you leverage it's so extreme, you can find yourself, your income doesn't pay for the loans. So don't leverage yourself that far. That was the mistake. That's the mistake of people who leverage 10% down, 5% down. The income is not paying the loan and the expenses. So if the economy turns, they're going to lose it all. And it's called a pyramid, a reverse pyramid. You lose everything. You don't just lose one. So some caution. And I'm talking, yeah. If you're experienced, I'm a professional investor, and the professional investment is a level up. It's more than leverage. It's what's called a leveraged buyout. You leverage 100%, and some of my best deals have been 110%. I've had the seller give me his property and give me 10% in cash on top of it. I structured it correctly. Not every deal is that way, but that's how I operate. That's how the really big boys. You don't have hundreds of millions of dollars of real estate by saving every month to buy the next property. It doesn't that doesn't work at that level anymore. You don't find deals. You make the deals. You sit down and you give the seller what he wants, and the seller's going to give you what you want, and you structure it until you do that. And that's professional investment. Yeah. So I started off like anybody else, but I ended up at the top, kind of.
Yeah. And we on other episodes, I know we've talked about quote unquote inflation. People saying, "Well, we're in a time of inflation," and so that's it's actually just a very robust economy. I mean, I don't know if you'd agree with that, but again, people are spending, and most recent job, employment rates are up, but that has led the Federal Reserve to increase interest rates as far as money that can be borrowed. And again, I'm not an expert. I'm on economics, I must admit, but there's from what I've observed over the years, there's a lag time, so that yes, the Federal Reserve last week or 2 weeks ago hiked the rate, 3/4 of a point, and they're probably going to do it again. Oh my gosh, employment is still going really strong. We better hike it up a little bit more. What do those Federal Reserve interest rate hikes mean in terms of real estate investing?
Real estate, and it should affect stocks. If the interest rate is much higher on the money you're borrowing, you can't, you might not qualify for a loan. You might not be able to get a loan. You might not be able to leverage. A small home buyer might not be able to afford a home. I'm not sure that this is the Fed's business. What they're calling inflation, I don't call inflation. We're coming off of a pandemic, and so demand has been pent up. Nobody has spent money for a couple of years. The poorest people have money in the bank at the moment, and they're competing for a more narrow supply of goods and services because factories have been closed here, China, everywhere in the world. And at the moment, China has been very tough on COVID, and they're closing factories all the time. They're not letting people walk around until it's over. And it seems to be a new virus coming up all the time, and they close factories again. So it's a genuine demand is exceeding supply and raising prices. That's not inflation. Inflation is when the dollar is worth less, and that's worth less because the government is printing money. That's pure recklessness.
Wheelbarrows of rubles or something like that.
Yeah, we printed some money for COVID, but I'm not sure we printed enough to cause rapid inflation, and we can afford it. So it's genuine demand. And I don't think the government should be raising interest rates. It risks a recession.
Yeah. Well, I want to follow up on that in just 1 second. I want to take a moment here to remind our viewers and listeners that this is a San Francisco conservative. You're listening to a San Francisco conservative in the form of the wisdom of my colleague, David Parker. And that's the title of our podcast series here. We're talking about real estate and the economy. And I know, David, you've mentioned a number of times, people are going into a panic, like, oh my gosh, a recession is on the way, and inflation, as you just punctured that myth, which was great to hear. But how do we look for opportunities? You've mentioned that the economy is cyclical, of course, and I know there's that beginner level that you mentioned, and then there's the professional level. But if we are headed into a recession, does that mean there are opportunities?
Absolutely. And some of my, maybe much of my wealth has come from making deals during recessions, because when the market crashes, all kinds of property and stocks, I suppose, also the loans, the mortgage against that property is worth more than the value of the property. There's no room for equity. There's no room for a down payment or for cash, because the loan is worth more than the building. And so at present, I've been trying to stockpile cash, waiting for that moment, because the bank will say, you can have all these properties. We don't want them on our books, but we're not giving them to anybody. We want to give them to somebody who can hold them during the downturn. I get back to that point. That's how people fail. They can't hold in a downturn. But if you can hold, and if you're prepared for a downturn, you have capital, you can really negotiate some very good deals. So people who are a little bit creative should be looking forward to a recession. You can pick up companies and you can pick up real estate for nothing down. Yeah.
I don't know if it's possible to be, this is encouraging news, no doubt. I don't know if it's possible to be a little bit more specific or give an example or two. Perhaps the real estate market there in San Francisco, with all the Silicon Valley companies, and as you've said, everybody making $1 million a year. is a little different from the New York City area. I mean, I live in Connecticut, which is certainly a wealthy, for the most part, wealthy area, but still some inner city areas. We sold our house in the previous town we lived in because a lot of New Yorkers wanted to flee the city. They had, people that bought our house had 6 children and so on. So we said it's a great time to buy or sell, rather, I must say. So, but are there any things that people should be looking for, to identify an opportunity?
Wherever you are in the economic cycle, you just adjust your strategy for that cycle. If you're at the top of the cycle, you can still buy. If you're thinking long term, if you're thinking 10, 20, 30 years at a time, just continue to buy. And if it's high, pay for it when the value genuinely is there. So give the seller a note. Here, I'll get a bank loan, and you're going to carry back the balance. And I'll pay you 10 years from now. And I'll pay interest 5% a year, something, and maybe low payments. And then 10 years from now, I'll pay it off. And at that time, the house will be worth much more, even if I overpaid for it at the top of the market. When the market is crashed, sometimes you have to just pay cash for it. And you wait a few years and you get a loan and you'll be paid back. And you go as if you have leverage for it. So you need cash when the market's down, and you don't use cash when the market's up. You just keep adjusting. You have to start thinking about it in those terms. In my book, I'm talking about people who are not thinking about it. Just buy that house next door every year for 10 years. And then you're done. You don't have to think about it again. You're financially independent. That's another approach.
Interesting. The other night, I walked into the living room. My college-age son, who's with us this summer, and my wife were watching a movie that came out a couple years ago. I don't know if you happen to see it, The Big Short, which I think was author Michael Lewis, who wrote the book about how all the big companies got into bundling those mortgages and so on. And they were, the main characters in the book could see impending doom or, the crash coming. So if they could short the crash, they'd make some money. It was quite a fascinating film. We all, I guess we all experienced that. Was that 2007, 2008? But could something like that happen again, or how do we prevent that from happening?
It's nobody's business. That's how it works. That's why the film, I didn't see the film, but that's my first thought is, yeah, that's how it works. When you think the economy is going to crash, short it. If you're playing that game, I don't play that game.
Yeah. But
that's the right thing to do. Yeah. And if the economy is crashed and all of a sudden it looks like it's picking up, go long. Yeah. Instead of go short. It's just nothing to think about. Yeah. Now the banks, 2008 financial crisis, they committed fraud. Those people all belong in prison, in my opinion. That's something else. I'm not talking about fraud.
So is what we're talking about, again, maybe, it's a sophisticated financial maneuver, certainly. It's not something I'm about to rush out and do, but is that what we're talking about? You talk about Adam Smith and the invisible hand and, the natural laws of the economy. Some people who are making a terrible mistake, if other people can predict that mistake has been made or how it will evolve, they're in a position to profit from it, right? Is that what we're talking about?
Well, that's what we were saying before. If you think the economy is going to crash, if you want to gamble, place a bet that it's going to crash, then do that. And the other way around. Adam Smith was talking about this, and what I talk about in my Income and Wealth is that the laws of money and economics and business are timeless. And there's no place for government in the economy. Because those who know how money is made just go around everything. Dodd-Frank and Sarbanes-Oxley are highly regulatory, but the biggest companies, they like it. They're like Brer Rabbit. Oh, please don't throw me in the briar patch. Please don't regulate me. And in fact, that's what they want. because it's so expensive.
Right.
Regulation, if millions of dollars a year just in attorney's fees to comply with Dodd-Frank and Sarbanes-Oxley. And only the big companies with low long-run average costs or economies of scale can afford it. And they'll say, bring it on, because then all the middle-sized and small companies will fail, and they gobble them up. You create a corporate state for a country. 10 corporations are running the whole country. That's a awful thing. You don't want to regulate the economy because of people who they know how to go around it. They're actually looking for it. The worst thing you could do is regulate a business economy.
Yeah, no, interesting. Maybe it's going off on a little bit of a tangent, but that reminds me when I've seen television coverage of Mark Zuckerberg of Facebook coming before a congressional panel, and they start asking him about, big data and, the whole internet technology. And clearly these elected representatives don't have a clue how it works. And
right,
reminds me of Brer Rabbit, as you said.
I don't see much I don't go to the movies, but I did see the movie about Facebook and that there was a lawsuit.
Right.
There was a lawsuit, and Mark is sitting at the table, and maybe it's against those twins, and he's trying to buy them out.
Right.
And then at one point he stops and tells the lawyers, you don't have a slightest clue what we're doing, anything about what we're doing. You know absolutely nothing. And that's how business sees government regulators. You have no idea what we're doing. You have no idea.
I will. Yeah.
So don't do it. Go away. Yeah.
Well, that's a perfect note to end on. And that tells us there's a lot of opportunity out there. Okay, that's a good thing. So anyway.
There's always opportunity.
Yeah. So I just want to let everybody know again, I definitely want to encourage you to pick up copies of David's books. You can find insights like this that can really change your life. I mean, they're really fantastic insights in income and wealth and a San Francisco conservative. And to learn about his jazz as well, you can go to daveparkersextet.com, but also for the books and essays and so on to davidparkeressays.com. And you can also purchase copies of those 2 books through Amazon. So thank you, David. Really appreciate it.
Great. Thank you, John.